An introduction to individual donor-advised funds. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. To keep up with the changing world of wealth planning, subscribe at iTunes, Apple Podcasts, Stitcher, Google Play, or other podcast sites. And now, our ACTEC Fellow host with today's topic.
This is Susan Snyder, ACTEC Fellow from Chicago. To give us an introduction to the rules that govern donor-advised funds, you'll be hearing today from ACTEC Fellows Ed Beckwith of Washington, D.C., and Professor Chris Hoyt of Kansas City, Missouri. Welcome, Ed and Chris.
I am Ed Beckwith. A donor-advised fund, or DAF, is a named fund at a sponsoring public charity. This podcast will review this flexible and attractive charitable giving vehicle. In a DAF, the donor, or the donor's designee, has the privilege of making non-binding recommendations to the sponsoring organization about which charitable entity should receive grants from the fund, and frequently, recommendations about investment of the fund's assets. Donor-advised funds have existed since 1931 and play a significant role in building two-way relationships between a sponsoring public charity and its donors. The term donor-advised fund was not defined in the Internal Revenue Code or in any corresponding regulations until the enactment of the Pension Protection Act of 2006. While the historic concept of a DAF was reflected in the definition, the Pension Protection Act added a long-standing best practice to the definition. Now, the sponsoring charity must clearly inform the donor that control of the gift will reside with the charity. This is required for the gift to qualify for a tax deduction. In addition to an expanded definition, the Pension Protection Act imposed reporting obligations on the sponsor and excise taxes on certain distributions from the donor-advised funds that fall within the new definition. Chris, tell us more about modern-day DAFs.
Well, thank you, Ed. Well, there's 2,400 organizations around the country that sponsor them, typically community foundations, Jewish federations, and the national donor-advised funds. The National Philanthropic Trust came up with a report that said that at the end of 2017, there were 463,000 donor-advised funds. By comparison, there's only 80,000 private foundations. And 1 out of every 3 donor-advised funds today was established in 1 year, and that year was 2017, as a response to the Tax Act, which we're going to talk about. They hold about $110 billion worth of assets. Now, private foundations have 7 times as much. They have $800 billion worth of assets. But with the private foundations, it's kind of like the public, the super rich. 1% of private foundations hold 62% of private foundation assets. In 2017, $29 billion was donated to donor-advised funds, and $19 billion was paid out. Now, by comparison, private foundations paid out $45 billion, but private foundations only distribute about 5.7% of their assets, and donor-advised funds are like checking accounts. They distribute about 18% a year.
Okay, how does a donor create a DAF?
Oh, it's so simple. A donor goes to a sponsoring organization like a community foundation, Jewish federation, National Donor-Advised Fund, and just sets up an account, make an initial contribution, and give it a name. Typically the name of the donor or the donor's family.
Well, how would it actually work once I've established the DAF?
Well, once the donor identifies a worthy recipient, they'll recommend a distribution to that public charity or to even a private operating foundation like a museum or a library.
Why is it that DAFs are so advantageous?
Well, the timing. You can make a very large gift all at once and then distribute amounts over future years.
They say that DAFs are tax preferred. Why is that?
Well, for 2 reasons. First of all, when you give to a donor-advised fund, you're giving to a public charity, so you get better tax breaks than if you give to a private foundation. But also under this new Tax Act, it's become harder to itemize deductions. In 2017, 36 million taxpayers itemize their deductions. Now it's only down to 16 million. And so very few people can deduct the charitable gifts. So you can concentrate your gifts. Like if you give $10,000 a year, put $40,000 into a donor advised fund, and that way you'll be able to itemize your deductions this year. And then future years, take the standard deduction as the donor advised fund makes the grants.
You were just comparing and contrasting donor advised funds to private foundations. What is the difference?
Well, with a private foundation, you actually have to form like a separate nonprofit corporation or trust. And you have the related costs of maintaining it, filing a tax return, and the like. And then with a private foundation, when you give certain assets like real estate or closely held stock, your tax deduction is usually less than if you give it to a donor advised fund.
Okay, so when do donors prefer a donor advised fund over a private foundation?
Well, there's probably four main reasons. The first is the convenience. You can set one up in a half hour compared to forming a private foundation and filing paperwork and applying for the tax status. Second is the cost savings. You have economies of scale. With a private foundation, you got to pay for the tax return and do all the administrative costs. The third is tax savings, that you can get bigger tax deductions when you donate certain assets like real estate that's gone up in value or closely held stock. And then there's the private foundation taxes, and one of them that's pretty important is the 5% payout. Every year a private foundation has to give away 5% of its assets. Well, if you're going to donate real estate that's only earning 1%, and it's going to take a few years to sell it, you really want a donor advised fund rather than a private foundation because you won't have that money to pay out.
Are there times when donors would prefer a private foundation over a DAF?
The three main advantages of a private foundation over a donor advised fund are number one, control, number two, control, number three, control. Control, control, control. Because with a private foundation, you control the governing body. You pick the board of directors. It's you and your family. Second, you control the investments. If you think you're so smart and you got rich through your own investing, you have to give that up with a community foundation or some other organization. And finally, the grants. You pick who's going to get the grant recipient. So if you really like control, the private foundation is very appealing.
But if I had a private foundation, would it be possible for me to actually convert it to a donor advised fund?
Yes, families with private foundations will sometimes terminate them or make grant distributions to their donor advised fund. And then it's save on the costs. And so very small private foundations, under $100,000, it makes a lot of sense to liquidate them into a donor advised fund.
Why contribute to a donor advised fund at all rather than contributing directly to a given charity?
Well, first is the timing. Like this year you go in the lottery, this year you're going to sell your business, this year you've got the big gift. And when this new tax law, you want to have lots of charitable deductions in 1 year to get your tax savings. And then you have some time to think about the grants you're going to make. And then you can consult the staff of the charity for worthy recipients and take your time.
That's great. What kind of assets could I contribute to a donor advised fund?
The most common gifts are cash, stock, especially publicly traded stock and bonds. But donor advised funds can accept gifts of all sorts of things like real estate, stock, closely held business interests, even intellectual property, and things that are less liquid.
To wrap up this podcast, Chris, tell us again, who should start a donor advised fund?
Well, first, someone who will benefit with this new tax law of concentrating the gifts in 1 year, the bunching of gifts. And second, someone who wants to be a philanthropist, who wants to have a philanthropic program for themselves or their family, and wants to have years of ongoing giving to their communities.
Thanks.
Thank you for teaching us more about donor advised funds.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. Please subscribe to this podcast and leave us a rating or a review at iTunes, Apple Podcasts, Stitcher, Google Play, or wherever you download your podcasts. Follow us on Facebook and Twitter at ACTEC Talk.